Thanks, everyone. Thank you for coming. Thanks, 131 students. Thanks, honor students. Thanks, other students. Thanks, faculty. Thanks, staff. Thanks, Haley. Thanks to the wonderful fourth floor and the Questrom School and the Merhotra Institute. Hopefully you had a wonderful night last night attending the introductory plenary panel. Today, you're here to hear from the honors students and our panel to talk about short-termism, and our emphasis in this panel is about the differences in institutions across countries that may lead to differences in the way firms behave with respect to their long-term investment plans. As you would have heard last night, there is indeed some debate about the extent to which short-termism is a problem, and there will certainly be interesting discussions in this session about the extent to which short-termism differs in the extent to which it is a problem across countries. And so we'll be able to call on some expertise from our panelist, Jay Zagorski, also from our panelist, Fernando Zapatera. Fernando, there you are. Thank you so much. The initial expertise will come from our wonderful honor student team of Adriana Ide, Zachary Held, hello Adriana, Zachary Held, and then Jenny Huang and Jordan Kramer. My job is mostly done. I'm supposed to kick off the panel, let you know what to expect. The next thing to expect is presentations from our honor students who've been working throughout the semester to try and understand this issue. They'll explain the issue. They'll explain a little bit about the debate about the issue. They'll give a perspective on how to think about why short-termism may differ across countries. And then they'll introduce some case studies. So with that, I pass things off to our honors student team. We have about 10 to 15 minutes for presentation, and the rest of the time will be for debate and discussion with our panelists. Zach, you're at the podium. I pass this to you.
Thank you very much, Dean Furman. That was a wonderful introduction to our topic. So as you can see, our topic is on the debate on short-termism, institutional perspectives, and country-level case studies. So my name is Zach. I'm Jordan. And we had the privilege this semester to work with Dean Furman on this project. So this is just a broad overview of our timeline. So we're just going to give a quick overview of what short-termism is to make sure you all understand what it is. And then we're going to go into the debate on it, kind of looking at both sides. And then we're going to go into sort of country-level case studies to look deeper into these systems. So first for our overview of short-termism. So sort of for a quick, maybe simple definition of short-termism is short-termism prioritizes immediate rewards over strategies that ensure long-term success and sustainability. So what this looks like is companies may emphasize quarterly earnings at the expense of other long-term strategies such as R&D, employee training, and infrastructure upgrades. And while this can boost short-term profits, this approach will undermine long-term future growth and competitiveness. So the goal of this, looking at specifically country-level case studies, is to look at different economic and regulatory frameworks to see how those either mitigate or amplify the effects of short-termism.
So now we're going to take a look at firm short-termism and how it varies across different countries and how it's shaped by national institutions. So the U.S. myopia is a management and a policy issue. And as scholars Hayes and Abernathy argue, U.S. businesses tend to focus on short-term immediate gains rather than long-term strategies, which can hinder sustainable growth and innovation. And there are two types of institutions. There's the CMEs and the LMEs. And CMEs, a good example of it is Germany. They tend to focus on stakeholders, on coordination and long-termism, whereas a good example of LMEs is the US, where the system tends to focus on shareholders, on flexible labor markets, and they tend to have governance structures with one tier to focus on shareholders. And the governance structures within LMEs tend to yield different outcomes.
Thanks, Adriana. So before we head into the country level case studies, we first wanted to understand how big of an issue short-termism actually is, if it is an issue at all. So we found that in empirical evidence, the results are kind of mixed. There's no positive or clear negative implication of short-termism on firm successes. So we have to look more at the theoretical observations of the issue. Now, when we're looking at defenses of short-termism, we're not saying that short-termism is a good thing for a firm to have, but rather that it's not inherently detrimental to the firm's success. So one such defense is that short-termism could enable financial security that will enable later long-term growth. So we can view here short-termism as a cornerstone that without short-term results, long-term growth wouldn't even be feasible for a company since it just wouldn't exist anymore. Another defense could be in quarterly reporting. We see that this enhances transparency for shareholders and investors. They know more about what's going on in the market and can make more informed decisions. Now, at the same time, these quarterly reports could be viewed as a criticism too of short-termism, since it could encourage earnings manipulation. Short-termism can also harm long-term growth. And we also see that stock buybacks are an inefficient use of capital that boosts the stock price instead of focusing on long-term strategy. So let's dive more into these pressures of short-termism now, starting with the quarterly reporting. So like we said before, it's a positive thing for investors and shareholders since they know more about what's going on inside the walls of the company. At the same time, though, we see that managers' performance is tied to quarterly earnings reports. So now there's an incentive for managers to skew their earnings, engage in earnings manipulation, or to cut costs primarily through R&D cuts, which would prioritize the short term in exchange for long-term, would prioritize short-term, harming long-term growth potential. Now we see in the US, companies have a mandate to report quarterly. The EU had a similar mandate as well. They since dropped it, but we still see many firms still choose voluntarily to report quarterly. Now, the next pressure we'll look at is shareholder activism. This is when shareholders will come to management and voice their complaints with something, saying they want an immediate switch in the management action. So this management can respond by appeasing shareholders, making a short-term fix that will boost the stock price. At the same time, that could harm long-term growth potential. Still, shareholder activism can be viewed as a positive for management since it can correct for over-optimism or bias in their long-term growth projections. Lastly, we'll look at the difference between public and private investments. So we see that public firms invest at rates far lower than those of private firms. Now, of public firms, 75% of them are managed with a long-term focus, yet the transaction and volume of daily trading is absolutely dominated by those public companies that have a short-term focus. So now we'll take a look at the implications of it at the country level.
Now we will take a look at 5 case studies, which will explore the approaches of short-term and long-term focus and corporate governance worldwide, and how regulatory and institutional factors shape corporate behavior. So first, the United States. The US has long struggled with short-term pressures, and long-term strategies show many benefits, including better revenue, earnings, market capitalization, and returns to shareholders. For example, among firms that focus on long-term, on average, their revenue and earnings growth were 47% and 36% higher. And that also did better during the 2008 financial crisis and recovered more quickly afterwards. In addition, they provide more value for society and economy by creating more jobs. From 2001 to 2015, they created on average 12,000 more jobs compared to firms that focus on the short term. And more jobs led to a significant GDP growth. So recognizing the risks of short-termism, the US government has taken intervention. The SEC sought public comment on whether shifting from quarterly to semi-annual reporting could help reduce short-termism and support long-term performance. Now let's take a look at China. China's managerial short-termism has a negative impact on corporate social responsibility. A study in China looked at over 23,000 firms from 2007 to 2022. The study looked at CSMAR as a metric, which provides a CSR scores based on a company's performance in 8 different areas, including employee welfare, environmental protections, and shareholder rights. So this company found that there is a negative effect of short-termism on CSR, although the impact differs across regions, ownership structures, and industries. So more developed regions show a stronger negative effects of short-termism on CSR, and state-owned enterprises are more likely to experience negative effects compared to non-state-owned enterprises, and non-polluting industries are affected more, while polluting industries benefit from strict environmental regulations that protect CSR from short-term myopic management.
All right, so now we'll take a look at the UAE. And the UAE provides a unique case of short-termism. For a while, the UAE's main focus is on short-termism, but recently they've been showing signs of switching towards more long-term. And their short-termism was mainly driven by rapid economic growth and also two main factors, including a transient workforce and also profit-driven real estate. And their transient workforce was supported by systems like their kafala sponsorship and also short-term visas. And that pushed for short-term quick growth, but it lacked long-term stability and talent retention. And with their profit-driven real estate, Dubai has seen a recent quick boom in real estate, especially with vacation rentals. And this was supported by relaxed property laws, and it attracted global investors and fast profits. And like I said, looking forward, it seems like there's going to be a shift towards long-termism, and this comes from their introduction of long-term visas and also 100% foreign ownership rules.
All right, so now the United Kingdom. So the UK most closely mirrors the US systems in terms of like its economic system and reliance on public equity markets. Two regulatory frameworks we found kind of early on was the corporate governance and stewardship codes. These kind of work to maintain oversight of how executive managers manage long-term focuses. And we found that they were initially quite effective, with over half of the FTSE 350 non-financial firms adhering within the first 2 years of it being passed. However, today we found that a lot of these challenges still persist due to a lot of enforcement difficulties, and non-compliant firms are offering minimal or no explanation for certain deviations. In Sweden, though, we found that Swedish firms often counter short-termism with stable dividend payouts that are often 3 to 5 times higher than those of comparable US companies. And we found that dividends like these serve as an indicator of sustainable financial management and are closely linked to sustainable performance. And we found that this has been quite effective, as researchers have found, quote, no material implication of short-termism, and this validates its success in this system. And if you look at this chart here, this is showing R&D intensity as a percentage of GDP, and of those EU countries, Sweden is sitting up there at the top.
So to conclude, three main key takeaways for this presentation. Short-termism impacts varies across national and institutional contexts. Short-termism is a debated approach for presenting both strategic benefits and potential risks. Case studies from global market illustrate how regulatory and institutional differences shape corporate behavior. So looking forward, a combination of regulatory oversight, long-term investor engagement, and corporate governance reforms can help firms balance short-term pressures with long-term success. Thank you for listening.
All right, and now I'd like to transition us into our panel. So I'd like to invite up Professor Zagorski and Professor Zapatero up to the stage here. All right, well, thank you for joining us. So if we could like to start, I would like to start with by introducing ourselves. I would like to start with Professor Zagorski and then to Professor Zapatero, just to give an overview of what your department is, what research you do, and kind of any other initial thoughts that you may have.
Right. Good morning. My name is Professor Jay Zagorski, and this gives you the opportunity to pull out your phones right now and say, you met the real Jay-Z. Okay? That other guy, his name is Sean Carter. My name is Jay space Z. Right. I have been here since before you were born. I've been here since some of your parents were born. Okay? I've actually had some Questrom students who've come in and gone, hey, Jay-Z, my mother had you. My father had you. All right. So that was a wonderful presentation. I'd like to give a round of applause for this group of honor students. But watching your faces, a number of you are like, short-termism, what the heck are they talking about? I don't get any of this. So let me put it in SM 131 terms. What's short-termism? Short-termism is a hookup tonight. What's long-termism? You're looking for long-term love, okay? So what do you do tonight? It's Friday night, or it's not Friday night yet, but it will be. What are you interested in, all right? Are you interested in a short-term relationship? By 1 a.m., you might not even know their phone number. Or are you interested in something that lasts for decades, maybe years? I can't tell you. But in business, they don't care about sex. They care about, what's the big word? Profits, all right? So our business is looking at short-term profits at the expense of long-term growth and money. I don't know. And that's the debate. Now, what the team was looking at was 5 different countries. Why 5 different countries? Because the question of whether you're interested in a short-term hookup tonight or you're interested in long-term love is a factor of a couple of different things. It's a factor of micro issues, what your parents are like, what you're like. Do you like risk? Do you not like risk? Okay. But it's also a factor of macro things. Macro things, what type of religion were you born into? How closely you're related to that religion? What type of, we'll call it socioeconomic background are you part of? What is your ethnicity? All these things have very different impacts on whether you're focused on short-termism or long-termism. That make sense? A little bit? Does that sort of explain what just happened in the last 15 minutes? Great. Fernando, I'll shut up now.
Thank you, Jay. Thank you to the organizers for inviting me. Congratulations for your presentation and for all the organization, the great work you did. I really enjoyed reading your paper and listening to your presentation. Jay, you probably don't get to be the first one alphabetically many times, so enjoy it. I've tried for many years, typically in academic papers, we list, unless there's some, for some reason, one contributor has been important than others in terms of the size of the contribution, we typically list almost all my papers, the authors alphabetically. Have never been anything but the last. So I've been close a couple of times, but so I'm Fernando Zapatero. I'm in the finance department. That's my field. I've been at EU for this is my 6th year. I was at USC before for many years, proud to be a terrier. My research, some of my research, so I work in finance, some of the issues have to do with short-termism. We're going to talk about the team work on discussing their paper have to do with governance of companies. I'm not an expert in governance. My research is more on asset pricing, but one of the areas that I'm interested on, I've been working on, in fact, I have 2 papers, working paper right now, we keep pushing, is the effect of short-termism in security prices. So let me back out a little bit, and put a little bit more of context on what we do, and actually nuance some of the discussion from the team. The presentation, Zach, and then Jordan in particular, they mention sort of interchangeably that short-termism leads companies to try to boost earnings in the short term. Jordan mentioned the stock price, and I think that distinction is very important. Short term is typically about the stock price. Let's back out even a little bit more. Why does short-termism happen? Why do companies focus on the tomorrow versus the next year? Well, it's because they get that pressure from the investors. Investors care, but the investors don't care about earnings. The investors care about the stock price. True, if you report good earnings, your stock price in general will be higher, but not necessarily. There are other ways in which you can boost your stock price. For example, Tesla says months ago, oh, we're going to have a robotaxi operational by the end of this year. The stock explodes. No change in earnings, but sure, you say, oh, what is the prospect that the earnings will change? Sure, but you are just selling some narrative, and that is enough to boost the stock price. So first of all, 2 things I'm going to talk about when we talk about difference in countries. I want to emphasize, short-term is about stock prices, shareholder value, famous Milton Friedman expression. I'm not taking a stand. It's just something that he said and is still widely accepted. The objective of management is to maximize shareholder value. Shareholder value is the stock price. They don't get a piece of the earnings, they might get through dividends a little bit, but wealth is share value. So that's one thing, and that's common wisdom in the US. You still talk regardless of ideology. I mean, I listen to many podcasts and everyone assumes that the objective, the goal of management is, not everyone, but most people will accept that the goal of management is to maximize shareholder value. So that's one. Another element I'm going to talk about, which is a big difference across countries, is one, who holds these companies. That's what leads to these incentives. If everyone is holding the companies and we are all worried about end of year and we hold the companies, well, we're going to put pressure on the shareholders. I want to see a good number at the end of the year because that's my wealth. Ensure my pension or my liquidity to buy a house, whatever. If fewer people own the stocks, that pressure will not be so strong. And I think that's one difference across countries that we're going to discuss. How in the US, many people, many of us own stocks directly or indirectly through pension plans. That's not the case in other countries. Things are converging. Things are converging. I think like some governments like it or not, countries are looking more like each other by the day because of globalization, communication, so on. A different discussion. But the truth is that still there's a big heterogeneity about who owns the stock market. And I'll stop here and move on.
Perfect. Thank you. That was a fantastic introduction and a great transition into our questions. So I'm just going to ask a question. It's open to either of you, no necessarily order or anything. You don't have to answer everything. But so my first question that I have for you two is, how do differing cultural attitudes towards risk and time influence the prevalence of short-term decision-making in corporate strategies across various regions?
Get your breath. Great. Okay. So short-termism is very different in very different countries. Let me tell you a quick story. My next door neighbor spent many years working in Japan, and Japan tends not to be a country that is focused on short-term profits. Okay? And the quick story he always tells me he loves is he was the CFO of a very large pharmaceutical company. That means making drugs legally. And he walked into the office the very first day, and there was a big conference room, and he walked through the door and sat down in the closest chair to the door. And everyone gasped, like, you can't sit there. I was like, why can't I sit here? I'm the CFO of this company. They said, oh, no, sir, the CFO has to sit as far away from the door as possible. Why do I have to sit as far away from the door as possible? And they pulled a chair out for him. They said, because since the Shogun times, right, we are very concerned about ninjas coming in and killing the head of the company. And he said, do I have to worry about ninjas coming in and killing me? He goes, no, no one's been killed in like 350 years. And he's like, then why can't I sit near the door? And they go, well, because this is Japan and this is the custom. So in Japan, short-termism is an idea because you're still worried about things that happened 350 years ago, right? That the CFO was murdered or the president or the prince was killed. While in the United States, many of us can't remember what we had for breakfast, and breakfast was only 2 hours ago. So in many different cultures, there's a very different time focus. And because here in the United States, we have a very short time focus. Can any of you remember midterms? Yeah, barely, right? Remember senior year of high school? Nah, it's too far in the past, right? So we have a very short time frame, and maybe that shortness in time frame is getting shorter over time. There's a lot of research that suggests that you have a much shorter time frame focus than I did when I was your age. Why? Because you use social media much more. It's like you're used to 15 seconds and bang, you're bored onto the next thing. So that develops a short-term focus in your lives. And when you graduate from Questrom and take over companies, and you will continue that short-term focus versus other countries which use less social media and have a much longer focus.
Well, I will go back to one of the points I was making, or let me make another fundamental point. I said before, what is the origin of short term? And I claim this comes from individuals. When individuals care about the short term and they translate that into pressure into companies that have to focus on the short term. Why do individuals focus on the short term? Something we discussed in our behavioral finance class. I'm really pleased to reconnect with some of the honor students who had the honor of sharing the class with over the last fall semesters. One thing we talk about is the peer pressure. You all guys go back to the point Jay was making about social media. So you all probably are in multiple media platforms, which anyways are great. But they also connect you with other people. And it's clear that one of the mechanisms that these platforms are using, Instagram, one comes to mind. I don't have an Instagram account, and this is one of the reasons, is it puts a lot of pressure on you. You're seeing how other people are doing. Immediately, people are saying, oh, look at this great vacation, this big party, this awesome jeans that I bought, whatever. And that puts pressure. I mean, we're human on everyone. I'm not by any means exempt of that. So that's something that translates into short term. So you have to worry, okay, how I'm going to go? There's this amazing concert next week. I'd like to go, but it's $200. Where I'm going to get the money? It's all the short term because my friends are going to go. At least the people I connect with in Instagram are going to go. That puts pressure in the short term. And that translates into companies. What is the difference across countries? There are cultural differences in this social pressure. So there are historical reasons, probably, reasons why in some countries that peer pressure maybe, the peer pressure exists everywhere. I grew up in Spain and I can tell you it's the same, but maybe manifests differently. Maybe here having a car we know is very important for many people, having a nice car. It's not the case in Spain. The cars for whatever reason. Madrid is a very congested city. It's impossible to park. You want a small car. I mean, it's just a fact. So that, but that doesn't mean that I don't care about other people. It's a different type of pressure. So different type of peer pressure. Here it translates to a lot of it is monetary, and then translates in how do I get to the end of the month and my wealth is higher. And that's a big difference across countries that's not fully explored in the paper, but the paper does, don't get me wrong, I'm not going to be critical, but one of the areas where the paper could go is into ownership structure. In the US, many people, many of you own stocks. I teach the derivatives class, and mind-boggling, the last few years, I asked people, why are you taking this class? Over the last few years, the response is, I'm trading options. So it's 10 years ago was unthinkable that they are all will be holding. But anyway, many people, many of us own stocks. That's not the case in many European countries. Why? Because here, even if nothing else for your pension plan. Now, it's changing in Europe, but in Spain, country are not the best. Most people have defined benefits plans, meaning my company, I'm going to get a pension from the government. Maybe my company will pay some of the pension, but I don't need to hold any money in stocks. So what happens to the stock prices? For many people, the answer in Spain, we don't care. That's not the case in the US. A big chunk of the population, especially decision makers, education and so on, care about the stock price, and that translates into pressure into the shareholders, and also pressure, and this is one of my areas of research, into institutional holders. The mutual funds, own huge chunk of mutual funds and hedge funds, institutional investors, pension plans, insurance companies. They own huge percentage of the market capitalization value, and they care about the short term. Why? Because their constituents care about the short term. One area of research, mutual fund asset managers are compensated based on very short-term incentives. There's data, there's a lot of people looking at that data. It became available in the last, whatever, 5 years or so. And it is a fact that the asset managers' compensation depends on the performance in the short term. So does that mean that I want to see a company that does well in the short term, or I'm going to dump it from my portfolio? So that's a big difference across countries. Who owns the stock? And then I'll talk more about it later. There is also a couple of points that I want to make, but I want to move on.
Thank you. Yeah. So you,
Chad, feel free to cut me off.
no worries, no worries. You're totally fine. So yeah, thank you for kind of opening up this discussion of like these cultural and economic differences between different countries. So kind of a follow-up question to that is, do you think that we are experiencing a convergence in short-termist behaviors across countries? Or do you anticipate that the policies and institutions that affect short-termist behaviors will remain sufficiently different so that firms continue to behave differently in different countries?
Well, I'm going to pass this off to Fernando, even though he just said he wanted a 30-second break, because he actually said that countries are doing convergence. So I'll allow him to elaborate.
Yeah, thank you. Yeah, that is a perfect segue. As I say, I think there's convergence. I mean, social media is prevalent, not only the US. I mean, 20-year-old kids in Spain, in Germany, in Portugal, sure, Nigeria, are using the same social media and are subject to the same pressure. And I see that as a factor of convergence. Also, I said before, who owns the stocks? Used to be the case, I mean, when I was a kid, my dad didn't have a stock. I mean, we're middle class. No one in my circles knew anything about the stock price. We will see the quotes on the TV, but we the Oscar award. Okay, yeah, I'm not there, but fine. I don't have anything against it. That changed. And many people now own stocks because pension plans, many other demographic factors, and so on, are pushing towards a different funding system for pensions. And so many people own stocks. I mean, everyone I know in Spain, cousins, brother, and friends own some type of stock. So that's changing. That's affecting also the pressure. There's still a couple of resistance points. One that I was going to mention before, I didn't talk about, which is the ownership, not only the distribution among the population, but the type of ownership of the companies. A big chunk of European companies, at least more than the US, more than in the US in terms of production of GDP, is owned by families. You know, Germany famously has thousands of small, middle-sized companies with maybe a couple of hundred employees, so it's not small, so people are entrepreneurs. There are thousands of those companies. They're big exporters, so on. Spain, similar. It's a different type of economy. Spain is more service-oriented than Germany, which is manufacturer-oriented, which, by the way, made me think about your use of R&D as a proxy, which is great, of short-term versus long-term, but has also to do with the type of economy we have. I mean, if it's a manufacturing company like Germany, sure, it's going to be just everything else the same, more R&D than in Spain. That is a service economy for the most part. But it's a different point. But the truth is that when a company is owned by a family, the incentives are very different. Are owned or controlled by a family, but mostly owned by a family. The incentives are different. I mean, if I'm a German entrepreneur and this is my company that I inherited from my parents and they from my dad or my mom, and they inherited from their parents themselves, and I want to pass to my kids, I worry about the long term. So I'm not going to do things that I don't care about the stock price because I'm not trading the company. I might trade a little bit of it, so it might be a public company, but I'm controlling it, and I'm not going to give up to pressures that might jeopardize the future of the company. When it's a public company that is owned by thousands of shareholders, the game is different. So that's something that is still there, and despite the convergence, is gonna be a barrier going forward. There's one or two more I can think of, but again, when I pass it to Jay, I will come back to them.
So in some ways, the big question of this paper, this project, is why do countries have different levels of short-termism versus long-termism? And one of the important things that Fernando brought up is the extent of family businesses. If a country has a lot of family businesses, the country tends to adopt a long-term focus. If the country has very few businesses that are family-owned, like the United States, then we tend to adopt a short-term focus. Well, why is that? Because if you're in a family business, your goal is to keep the family business going for as many generations as possible. And family businesses can take more risks because, as Fernando says, many of them, but not all, are really not publicly traded. Many of them are just privately held. So as a quick example, how many of you look at fashion magazines? Any of you? Fashion websites, these kind of things? None of you care about clothes. You're like me. All right? I get it. But if you ever did look at a fashion magazine or things like that, most of the big fashion houses tend to be family businesses or family controlled businesses. And they have the ability to come out with outrageous designs every year because they don't care about short-term profits. They're really interested in long-term, for example, fashion or long-term jewelry or things like that. So some of the most powerful fashion companies in the world tend to be controlled by just one or two very, very wealthy families.
Perfect, thank you. So now kind of looking in a bit of a different direction, this also might apply to a lot of our SM131 students here today. In what ways can the integration of ESG metrics into investment decisions alter a firm's focus on short-term versus long-term outcomes? And how does this differ by region?
Fernando's looking away, so that's me. What's ESG? ESG, anybody help me out? What's E stand for? Environmental, great, okay. The world. What's S stand for? Social or society, okay. And what's G stand for? Governance, great. You all got an A plus on the JZ exam. Unfortunately, I'm not grading you this semester. Wait till next semester. All right, so ESG, if you're taking an ESG approach, the goal of ESG is to think, say, about the world, all right, to think about things like global warming, which means you're trying to adopt a long-term focus. You're not worried about just today. You're trying to ensure the world is around for the next 10 or 20 generations, right? Same idea for governance. Developing good governance policies enables the company to keep operating not just this year, but 20, 50, 100 years into the future. So by putting in ESG, it forces a company to develop a more long-term perspective and shift away from short-termism instead of being very this quarter focused. It's much more, how are we sustainable for the exceptionally long term?
So I agree with what you said, but let me nuance this a little bit. It is true when we talk about, and this is something that we were talking before we started today, with my little group for Clancy and Marcel, who were discussing particularly this topic. It depends on what you call long term. So if we're talking, which is I think is also something we take for granted. I mean, short term is what is short term. Depending on the context, short term versus long term could be a month versus a year, or could be a year versus 5 years, or could be 3 years versus 20 years, depending on the context, depending on what we're talking about. I think in terms of environment and sustainability, when we talk about the very long term. I mean, we all want to be around. I mean, some of us will not be here, but you all want to be around in 50 years, right? So it's not clear that the world will exist in 50 years, the way things are going. I tend to be a little bit of a fatalist. I'm personally an optimist, but when I talk about look at the scenarios, I tend to be a pessimist, and I see some signs. I mean, I hope that's not the case, but not guaranteed, right? World will be around in 50 years. So we're worrying about sustainability, that long term, sure. I mean, sustainability is very related, environmental, the E part is very related to long-term versus short-term. But we are talking 1 versus 5 years. I'm not sure that's the case. And to be honest, I'm a little bit cynical or skeptical at least about the ESG denominations. There's a lot of gaming about it. I did a little bit of work on this last year, conference was attending, and one thing I learned is there is this debate, or from a finance point of view, it's important. Does ESG qualifications or ESG rating affect your stock performance? There is no consensus there. Some studies find, yeah, ESG means that you are sacrificing some things, and then, of course, your earnings are going to be lower, your performance is going to be worse. But some studies think that is the opposite. So I think, and there is clearly a lot of evidence, there is a lot of ESG gaming, ESG rating games. There has been things like the ratings will come after discussions with the companies will adjust their brochures, some other strategies and so on, ways that were cosmetic just to get a different ESG rating. So bottom line, is there a relationship? Sure. But in my mind, the relationship is way more long-term than what we typically talk about when we talk about short-term versus long-term, which is, I think, in most cases, we're talking 1 year versus 5 years. I don't think 1 year versus 5 years, the relationship between ESG and short-term or long-term is very tight.
Perfect, thank you. So I think we have time for one more question now. So kind of on the topic of trying to have a world in 50 years from now, looking forward, what structural changes do you believe are essential for fostering long-term strategic thinking in corporations on a global level?
So since we only have a couple of minutes left, whenever you're faced with a couple of minutes left and you want to say something, ignore whatever question is actually given to you and say what you want to say. All right. So a long, long time ago, I was introduced to short-termism. I was in a bar when I was roughly your age, and it was legal to drink. Don't worry about that. And the bartender was complaining. This was in London, that the company was just so short-term focused. And he had doors leading into the basement where he stored his beer. And the doors needed to be replaced. And he kept saying to the company, replace the doors. And they would send somebody out and they'd tighten the screws, maybe do a quick weld. And then the next quarter, they'd send somebody out again. And he says, can't you just replace them? And the response from management was, no, it's going to cost too much. It would take a hit this quarter on the manager's revenue. So I'm not replacing your doors. I'm going to just keep sending someone out for an hour or two. And we'll keep doing this, even though the long-term cost is going to be more than taking that one-time hit. And for many years, I was a strong believer that short-termism is bad, bad, bad. Never do it as a manager. But lately, I believe short-termism is the way to go. When we are right now in a period of extreme turmoil, where you have no idea whether tariffs are up or down, whether what you're doing is legal or illegal, you should, as a business manager, adopt a short-term focus. And a long-term focus, I think, is for fools when you have no idea what the future is going to look like next week, never mind 10 years from now.
One thing I echo Jay's final thoughts. I think there are also things true, I mean, in terms of institutions. For one thing, back to my initial point, where is the short-termist pressure coming from? I think from individuals. So it has to be, first of all, change. And the same thing has happened with the E in ESG and the S. Well, it has to be more of a social conscience that the future is at stake, and that we cannot be worrying or put pressure on people to worry about tomorrow. I mean, I echo that there's so much uncertainty that we'll be happy if we make it to the end of the year. But I echo the point, but from a design point of view, from a political point of view, I think there's an opportunity to understand, to these people, or at least to bring people to the discussion about the long-term, short-term effects of many of the measures we're taking, and there are institutions that can help with that. I mean, the paper, they have details about that. One institution that I think, and I'm not advocating for it, but I think that makes a difference, is one of the point I didn't discuss before, is one institution that I think makes a difference is trade unions. That's a big difference between European countries and the US. Trade unions in Europe are, Spain, Germany, are very powerful. And you might say, oh, too powerful. Maybe, okay, so this is fair debate. I'm not taking a stand, but the truth is that they're very powerful and they represent society. They're very powerful, not only in the companies, they're very powerful in the government. In Spain and Germany, in Spain, the government is now a coalition of socialist and left of socialist parties, and they all have their own trade unions, and they talk to their trade unions all the time. So they are part of the same political institution. So they have a lot of influence in the government. So they put pressure in companies, they put pressure in regulation, and that definitely affects. I'm not saying that this is ideal, I'm not taking a stand, but I see some problems with it. But that's one way in which you put pressure on companies, government, in their goals. But definitely is the case in Germany, where companies are run, and there's the owners, there is management, and there is employees, are typically part of the board of German companies, and they have a voice and a vote, and they can veto decisions, so they can put pressure, because employees, of course, care about the stability of their job. So there are institutions that can complement that, but I think all starts at the society level. I mean, it's grassroots. Conviction that this is the way to go, and then build it from there, families, your friends, to your companies, and then of course to the political representatives.
All right, thank you so much. So that concludes our panel on the debate on short-termism. Thank you so much, Jay-Z and Professor Zapatero, for such an informative panel.